Okay, let's unpack this. We're doing a deep dive today into something huge that happened in India's energy landscape. We're talking about the third quarter of 2025.
It was a complete game changer. Not just a little bit of growth, but a seismic shift.
So for anyone tracking global energy, the headlines alone must have been pretty stunning. Let's start with a big one, the 500 gigawatt mark.
It's a massive number. By the end of September 2025, India's total power generation capacity officially crossed half a terawatt. It landed at 500.9 gigawatts.
Half a terawatt. That puts India, what, third in the world now?
Third largest, yeah, right behind China and the US. But look, the real story here isn't just the total size. It's about what's inside that number, the composition.
Right, the mix of energy.
Exactly. We've hit this incredible tipping point. Non-fossil fuel capacity, so renewables and nuclear, is now at 256 gigawatts.
Which is more than half.
It's 51.1% of the total. Think about that. India just hit its 2030 national target for clean energy capacity.
But they hit it in mid-2025.
5 years early. It's an unbelievable acceleration. It basically proves that all the big bets they made on policy and investment, well, they paid off.
And a huge part of that story, of course, is the corporate action behind it. We have to look at the giants, like Adani Green Energy or AGL.
Oh, absolutely. They're a central driver. They just brought another 300 plus megawatts online in Gujarat.
So our mission for you today is to really get under the hood of these numbers. We want to analyze the forces driving this, from, solar's dominance to global money pouring in.
And then we need to scrutinize the financial plumbing, the debt, the liquidity, especially these complex structures the companies are using to fund it all.
That's the mission. So let's start with that macro picture in Q3. You used the word seismic. It sounds like capacity wasn't just added, it was almost dumped onto the grid.
Dumped is a good way to put it. In that single quarter, India added 16,071 megawatts of new capacity.
16 gigawatts.
In 3 months.
It's the highest net capacity addition in a quarter, ever. And the type of capacity added, that tells the whole story of where the country's heading.
It really does. The vast majority of it, 82.8%, was non-fossil. And solar was it was the undisputed king.
What was the share for solar?
69%, just from solar alone. That's 11,084 megawatts of solar coming online in 90 days.
11 gigawatts. I mean, to put that in perspective for everyone, that's like building 5 large nuclear power plants.
But in a single quarter, using sunshine, it's astonishing.
And the year-to-date numbers are just as wild. From January to September 25, net additions were up almost 60% compared to 2024. What caused that specific hyper-acceleration?
It's a powerful mix. First, the pure economics are just undeniable now. Cheaper renewable power is actively kicking more expensive fossil fuel and nuclear plants off the grid.
But there was a policy element too, right? A deadline.
A huge one. There was a 100% waiver on interstate transmission charges, the ISTS charges. That was set to expire in mid-2025.
So it created a race.
Exactly. A regulatory ticking clock.
Yeah.
It forced all these developers to rush to get their projects commissioned before that deadline to lock in the lower costs. It pulled thousands of megawatts forward.
And when capital sees efficiency and a hard deadline, it moves fast. Tell us about the money that followed.
It's historic. Investment in the renewable sector just exploded. It was up 112.6% year over year in Q3, hitting over $5.2 billion.
In one quarter.
And get this, the total investment for the first 9 months of 2025 was $18 billion. That 9-month figure is already more than the full year totals for 2022, 2023, and 2024.
Wow. So we've clearly crossed some kind of inflection point. Global capital isn't seeing this as a risky green experiment anymore.
Not at all. It's a mature, risk-adjusted infrastructure play. And you're seeing huge interest now from global private equity, sovereign funds, and they're targeting the really complex projects.
The hybrid ones.
The hybrid ones, yeah. Combining solar, wind, and crucially, storage, because that's the key to delivering firm, reliable 2047 power.
Okay, but this is where it gets really interesting for me. Because, success creates its own problems. You have this explosion in making power, but the pipes to get it to people, they just can't keep up.
That is the emerging bottleneck, 100%. We have all this new generation, but the midstream, the transmission and distribution grid, is seriously straining.
And we're seeing proof of that in the data.
We are. The grid controller of India reported a significant jump in solar generation curtailment.
And curtailment just to be clear, is when you have to basically switch off a power plant because the grid can't handle the electricity.
Exactly. You're producing power, but there's nowhere for it to go. And that rose by 12% in October 2025 compared to just a few months earlier in May.
So the problem has shifted. It's not a generation problem anymore.
The generation problem is, for the most part, solved. Now we have a power delivery problem.
And that bottleneck seems like the perfect pivot to talk about a company like AGL. They're defining the scale of the boom, and they're right at the center of this whole curtailment challenge.
They are synonymous with scale. They just announced another 307.4 megawatts of new capacity is operational, a mix of wind, solar, and hybrid in Khavda region of Gujarat.
And that little boost took their total operational capacity to, what was it?
Just over 17,200 megawatts, or 17.2 gigawatts. But the real story is what they're building next.
In Khavda, yeah. The giant energy park.
The world's largest renewable energy plant. They're targeting a mind-boggling 30 gigawatts there by 2029. And they already have 7.1 gigawatts up and running.
It's hard to even visualize that. We're talking about an area just for solar and wind that's hundreds of square kilometers.
It's an engineering marvel.
Yeah.
And you see that operational success flowing right to their bottom line. For Q2 of fiscal 26, their consolidated net profit was 644 crore.
Which was up, 28% year on year?
A substantial 28% jump, yes. And their energy sales were up 39% in the first half of the fiscal year. They're not just building capacity, they're selling the power.
And they're backing this all up with massive long-term capital commitments.
Huge commitments. The Adani Group as a whole is planning to invest around $60 billion in India's power sector by 2032.
$60 billion.
And that's not just generation, it's also in transmission and distribution, which, as we said, is the critical bottleneck they need to solve. AGL's specific target is 50 gigawatts of renewable capacity by 2030. They're putting $21 billion toward that goal alone.
So this kind of ambition, it obviously requires incredibly sophisticated financing. Which brings us to the core question for any analyst.
Yeah.
How healthy is the debt that's funding all of this? We have to get into their restricted group financials.
Right. And this is where we need to slow down a bit. For listeners who aren't familiar, when a company like AGL builds these huge assets, they often create a separate legal entity, a restricted group, or in this case, RGI.
And they put the assets, the revenue, and the debt for those specific projects inside that ring-fenced box.
Exactly. It protects the bondholders. It isolates these stable, cash-generating assets from any volatility in the wider parent company. It's a very common project finance structure.
So when we see a rating agency like Moody's talk about the RG type profile, they're only looking at that protected, stable core of the business.
Precisely. And that's why those ratings are so important for getting future funding. And the news there is good. The credit profile for AGL's RG is stable and even improving. India Ratings just upgraded them to A stable.
And Moody's?
Moody's revised their outlook on the restricted groups from negative back to stable. It signals a strong belief that these assets can easily meet their debt payments.
Which we can actually see in their covenant performance. What do those safety metrics look like for the 12 months ending in September 25?
They're performing extremely well, way above the requirements. Let's take the main safety buffer, the debt service coverage ratio, or DSCR.
And that just tells us how many times they can pay their yearly debt bills using their cash flow, right?
That's it. Their DSCR came in at 2.53 times.
And the requirement for the bondholders was?
Only 1.55 times. So that spread, that's a massive financial cushion for them.
A huge margin of safety. What about their overall leverage?
For that, we look at funds from operations to net debt. It basically shows how quickly they could pay off their debt. That ratio was 20.2%. The minimum required by the covenants was just 6.0%.
So again, the actual operations are dramatically outperforming the financial promises they made.
By a very wide margin.
And for that operational stability, you need predictable customers. Who's actually buying all this power?
And this is what's so fascinating and so important for the bondholders. The revenue security. 72.5% of the RG Ty's operating income comes from power purchase agreements, or PPAs, with sovereign counterparties.
So government-backed entities.
NTPC, SCCI.
Yeah.
Essentially, the Indian government is the main customer. That provides an incredible level of predictable long-term revenue. It strips out a lot of the market risk.
They also seem to be really pushing the envelope on operational efficiency.
They are. They're consistently generating more power than their minimum commitment, which means a really high capacity utilization factor. And they're using incredible tech.
Like the robotic cleaning.
Yes, they've deployed waterless robotic cleaning across 9.6 gigawatts of their solar panels. It's the largest deployment of that tech in India. It boosts efficiency, and in the first half of fiscal 26, it helped them avoid over 14 million tons of CO2 emissions.
Okay, finally, let's look under the hood at how money moves around inside the group, because this can tell you a lot about liquidity management. Is RG2, because it's so strong, basically acting as a bank for the rest of the Adani ecosystem?
In short, yes, RG2 is a cash-generating machine, and it has extended pretty substantial loans called intercorporate deposits, or ICDs, to the unrestricted group entities.
The parts of the business that aren't ring-fenced.
Correct. As of September 30th, 2025, those loans totaled over 12,500 million INR.
And the terms on those internal loans are pretty interesting.
They are. The tenure was just extended by 3 years, with an option for 2 more, and they carry high interest rates, between 10 and 10.6%. So on one hand, it shows how strong RG2 is. It can afford to lend out cash, but it also shows how that cash is being deployed to support the wider group, earning a nice interest rate for RG2 in the process.
Okay, so let's bring it all together. What does all this mean? India's energy transition is moving at a speed that's just. It's blowing past all the targets. Hitting the 50% non-fossil goal 5 years early is the headline.
And it's being fueled by this massive capital deployment from players like AGL. And when you look inside their financials, at least within these restricted groups, the debt structure looks robust. They're overperforming operationally.
But the whole system is now facing a new problem. We're building solar panels faster than we're building the highways to carry the power.
The challenge has fundamentally shifted, yes. The bottleneck is no longer generation, it's distribution. And that rising curtailment is the proof. That bottleneck is the next inevitable multi-billion-dollar investment cycle.
Which brings us perfectly to our final provocative thought for you, the listener. You've seen the data. India is a top 3 power capacity holder. Renewables are over half the mix. But the grid is struggling to keep up. So where does the next big wave of investment really need to go?
You have to look beyond the panel makers and the big generator.
Exactly. Look toward the companies that enable efficient energy flow. That's where the next opportunity is.
The capital is going to move from the generation field to the transmission backbone. It has to.
And now for our This Is Not Financial Advice segment, our outrageous but plausible trade idea based on everything we've just discussed.
All right, I'm ready. Let's hear it.
The idea. You short a generalized renewables ETF, one that's heavily weighted towards solar generation companies. And at the same time, you go long on highly specialized midstream companies.
So firms focus purely on interstate transmission systems or utility-scale battery storage, a classic pairs trade. What's the logic?
The logic is pure market physics. You have an unprecedented volume of generation, that's 16 gigawatts in 1 quarter, slamming into a grid that's already buckling. That's what curtailment is.
So the marginal value of one more solar panel actually goes down for a while.
Temporarily, yes, because you can't get all its power to market. The government has pushed capacity so hard that now transmission and storage are the immediate painful bottleneck. So you bet against pure generation, and you bet on the complex capital-intensive infrastructure needed to actually monetize that generation boom.
You're positioning for the next inevitable infrastructure cycle. After the gold rush for generation panels is over, you invest in the companies building the roads to get the gold to market.
That's the play. A compelling argument, I think, rooted right in the physical imbalance of the Indian grid.
This data certainly supports a strategic shift in focus. It's a fascinating setup.
That's it for this deep dive. We'll see you next time.